Another weak sale of US Treasuries further weighed on market mood yesterday ahead of today's US GDP update and tomorrow's inflation figure. Then an uptick in German inflation also weighed on appetite in Europe. So the US dollar gained and crude oil failed to extend gains above a key resistance. So welcome. This is Swissquote's Daily Market Talk. So market mood further darkened yesterday following another round of weak sales of treasuries in the US. This time, the 7-year note auction failed to attract enough demand on Wednesday. And remember, the 2- and 5-year auctions also saw quite a weak demand earlier this week. So, the US Treasuries remained under pressure yesterday. The US 2-year yield, which best captures the Federal Reserve's rate expectations, will shortly hit the 5% psychological mark. The US 10-year yield spiked to 4.63% level, and the US dollar index advanced to the 50-day moving average and is consolidating near that level this morning at the time I'm talking here. Now things could get better or worse in the coming hours of trading because, well, the Federal Reserve's beige book, revealed yesterday that the US economy expanded at a slight or modest pace since April, while consumers, push back against higher consumer prices. The latter would be good news for the Federal Reserve, who desperately needs the consumer demand in the US to slow down in order to progress in what they call the last mile in their inflation battle to hit their 2% inflation target. So all eyes are on the US GDP update due today and the Federal Reserve's favorite gauge of inflation, which is the core PCE number that is due tomorrow. So the US GDP is expected to have slowed significantly in the first quarter of this year with, however, a significant rise in price pressures as well, but that's already priced in. While the core PCE print for April could hint at some easing in this latest pickup in inflation in the US. So the best outcome from this data would be a relatively solid, not too much deterioration in growth with easing price pressures, but we could realistically get a, slowing growth and insufficient easing in price pressures instead. To many, and especially to the Fed, the inflation number will matter more than the growth updates, as regardless of the deteriorating economic growth in the US, it is the progress in inflation that will determine whether the Federal Reserve could remain on a solid path or on a path to cut rates this year. Therefore, it will be quite hard to interpret today's GDP data before seeing tomorrow's PCE print. So voila, I'm sorry, but we will have to be a bit more patient this week. And even then, Citigroup thinks that this week's economic data will trigger only limited price action, and that the upcoming US jobs and CPI updates in the next weeks will just matter more. So that's what they think. For now, note that the rising yields in the US and elsewhere are taking a toll on stock valuations in the absence of other and, ideally positive catalysts. In this context, the S&P 500 slipped below the 5,300 level at yesterday's trading session, and Nasdaq retreated as well. The US futures are in the red again this morning at the time I'm talking here, as Salesforce tumbled 16% in the after hours trading after the company reported a weaker than expected revenue growth in the first quarter of this year and after it gave a softer than expected outlook as well. Elsewhere here in Europe and there in Australia, the price pressures are also coming back to the headlines. So released yesterday, the Australian inflation figure unexpectedly rose in April, and the German inflation also came in worse than expected by analysts. It appears that, inflation in Germany rose from 2.4% to 2.8% in May. That's more than 2.7% penciled in by analysts. So the German 10-year yield advanced to the highest level since last November, and the European STOXX 600 index tanked more than 1% at yesterday's trading session. Spain and Italy will be releasing their inflation updates today, France tomorrow, and we will be having the aggregate CPI data for the entire Eurozone, well, tomorrow morning. Now, unless we see a big surprise in the inflation front, which I don't think will happen, the ECB will probably announce a 25 basis point rate cut next Thursday. But an inconvenient rise in the Eurozone inflation will certainly vanish the expectation of a second rate cut in July meeting. But for the euro-dollar, it doesn't really matter much. I mean, if the Federal Reserve's rate cut expectations vanish faster than the European Central Bank rate cut expectations, then the euro-dollar should remain under a decent selling pressure from the actual levels. The pair slipped below the 100-day moving average yesterday and is testing the 200-day moving average support to the downside. This morning, we are below the 108 level. Again, the only thing that could eventually throw a floor under the euro-dollar sell-off this week is a sufficiently soft growth and sufficiently soft inflation figure from the US. And if that's not the case, well, the euro will probably further melt against the greenback, and this will also be the case for other major currencies as well. Cable sank below the 1.27 level this morning after failure to clear the 1.28 resistance earlier this week. The dollar yen consolidates above the 157 level this morning as the Aussie dollar slipped below the 66 cents support to the downside just this morning. In the precious metals front, while gold extends losses against a broad-based strength in the US dollar and the rising treasury yields in the US, but the uncertainties and the geopolitical tensions and the rising risk aversion could limit the gold sell-off near the $2,300 per ounce level moving forward. Now, happily for everyone who doesn't have a positive exposure to energy and to energy stocks, well, oil prices don't gather enough momentum above a key resistance, well, to further fuel the inflation worries around the world. So the US crude, for example, sees a decent resistance above the $80 per barrel psychological level, as waning rate cut expectations from the major central banks around the world are waiting on global oil demand outlook and give the oil bears a good reason to remain in charge of the market near the critical $80 per barrel resistance. Now, obviously, the ugly geopolitical situation in the Middle East does trigger some short-term price spikes in oil prices, but these price rallies due to geopolitical tensions in the Middle East tend to remain quite short-lived and will do nothing more than bringing in the top sellers. So, oil's inability to gain a sustainable positive momentum to the upside is weighing heavily on energy stocks as well. Exxon retreated to the lowest level since March at yesterday's trading session as Chevron extended losses below the year-to-date bullish trend base. ConocoPhillips, on the other hand, tumbled more than 3% yesterday on news that it will acquire Marathon Oil through a $17 billion oil stock deal, while Marathon Oil jumped more than 8%. Now, the ongoing consolidation in the Permian Basin will obviously help the US big oil companies benefit from synergies and scale economies, and hence help them squeeze higher profits from their operations. And note that at one point in time, the correction in energy companies' share prices will eventually become interesting for investors regardless of the economic picture and the central bank prospects. Because if inflation eases, the softer central bank expectations will eventually boost the reflation rate and will benefit to big oil companies. And if inflation doesn't ease, God forbid, and central banks step back from their rate cutting plans, then the big oil's juicy dividends and buybacks will end up attracting investors who are looking for that extra revenue to navigate through these high inflationary pressures. So this is all for this week for me, not for you, but for me, because I will be off this Friday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading.